Good afternoon. Happy Friday. Welcome back to the weekly market analysis for the week ending April 28th, 2023. We are at the end of April already. So 1 month of Q2 is down, and we've seen a lot of action just in the last few days on the markets. I just want to take a moment before we jump in today to remind you to hit the like button and subscribe to the channel. It really helps me out. And then you can also find me on Twitter at Mr. J. Thomason. And you can subscribe to my free weekly newsletter on Substack at befinanciallyfree.substack.com. I'm going to put out some pretty good stuff this Sunday. I think it's always good, but I'm going to definitely be putting out some good stuff this Sunday because there's a lot of stuff to go through. What I want to start off with today is just this. I'm going to start on the NASDAQ because we've basically seen big tech earnings, and that's kind of maybe a misnomer. I'll explain what I mean in a minute. But we've basically seen the mega cap companies holding up the markets, and actually this year, just across 2023, the largest percentage of gain total in specifically the S&P, but also in the NASDAQ, is concentrated in fewer than 10 stocks. And to me, that's concerning. I talked last week and also in my newsletter about market breadth disappearing. I don't think that bodes well. And it's kind of funny because even as I say that today, the NASDAQ here closing at a new high for the year. Obviously, it's wicked a little bit higher back in the beginning of April. But the NASDAQ is closing at the highest level that it's closed at so far in 2023. And basically, in 3 days, we have engulfed all of the price action of April. I mean, April was basically down from the start. April had been a kind of correcting sideways. I mean, if you look, if we just use the NASDAQ as the example, since that's what I'm on, starting on April 3rd, now the drawings came back, we had fallen as far as 3.5%. So that's honestly, that's kind of a long time to, I mean, a whole month to only go about 3% down is really interesting. But in the last 3 days, starting with Tuesday after hours, obviously, so I don't count Tuesday because it was just after hours, but starting on Tuesday after hours, you have, I believe it was Microsoft and Google giving earnings reports, and basically, the markets have just rocketed up. So, Microsoft was up 8%. Google ended up not being up very much after hours, but it ended up. But then, Wednesday we had on Wednesday after hours we had Meta that gave its earnings report, and it went up like 15%. And then, of course, so that's why we had a huge up day yesterday. And then on the close yesterday, we had Amazon earnings, and Amazon initially popped and then actually sold off in after hours. But then today we kind of just saw a steady grind. I like using the NASDAQ. It was just really interesting watching the NASDAQ. So obviously sideways, including pre-market. But this is kind of the gist of what the day was like. You've got basically markets open. Markets had been down overnight. You can kind of see markets were falling and low overnight yesterday. And then we had a kind of a spike up for the first hour. We sold back down to our lows, around our lows by 11 Eastern today. And then just kind of was a slow, methodical, a little bit up, a little bit down, a little bit up, a little bit down, but just making higher lows all throughout the day. Kind of flattened out midday and then had a really big push to close. And we closed up pretty strongly. And I was kind of watching, to go back to the daily for just a second. I was watching to see if we would make a higher high on a closing basis than our Friday, March 31st candle, and we ended up doing that. And so, like I said, since Tuesday after hours, it's only taken 3 daily candles to engulf the entire last month's price action. So April, believe it or not, actually ended the month up on the NASDAQ, ended the month up on the S&P 500, ended the month up on the Dow, ended the month let's see, did the Russell? No, not on the Russell, but obviously the Russell is full of a lot of these small banks, regional bank stocks, so that's been getting harmed from that. So basically, the story is that the mega cap tech companies. So like, let's go to XLK for just a moment, so we can see the price action there. You can see the price action basically following the Nasdaq. If we go to MGK, which is mega cap, you can kind of see that that has been basically on a tear. We didn't see the same kind of pullback generally that we saw in the other indices. This kind of actually looks a lot more like the S&P 500. But basically, mega cap earnings saved April, and saved the indices from having not just a bad week but a bad month overall. And so if we just check in on our levels, we've got the Nasdaq coming in around 13,320. We've got the S&P just about 12 points shy of 4,200, right around its highs from the year. So we saw these highs back in February, on February 2nd. And so this is going to be a pivotal moment. This is, if we break up from here, then the next big test is going to be the August 22 highs, which were just above 4,300. So we want to watch that. Just in hindsight, I don't personally usually, as far as my trading rules go, I don't personally usually take the trades on the touches of the colored line. I usually wait for the pullback to come back below both the colored line and the faded gray line, as long as on longs, as long as the colored line is above the gray line. So here I wasn't looking for entry, but it is interesting that it did catch support right there on that line, especially right after getting a strength reset indication here. So that's kind of interesting to note. I was also watching the Dow, so I had this descending trend line. It actually looked like it was going to close below, and it didn't. It actually popped above, so we'll be watching price action Monday and Tuesday to see if this will hold above or if it ends up being a fake breakdown. And then the Russell has been really struggling with this descending trend line right here, coming in at 1774. The Russell just can't get off the ground, and I know that a lot of that has to do with the regional bank stocks, but there is concern. Like I brought this up a lot in 2021. I didn't like that we were seeing sideways action on the Russell the entire time, and then we obviously got that prairie dog, which led us into the 2022 bear market. I don't like that the Russell is lagging here either. So I do want to call that out. Its momentum is down. You can see the tide line is below the gray line, so that's not a good sign. So even while mega cap earnings have kind of saved the markets this week, I have concerns, and I think that there is potential. I still think that there's a correction ahead. That's my take on this, and I think that it could come, I was assuming it was going to happen this week or start this week, and it looked like that was happening until tech earnings. But I think that there are various metrics that are signaling that downside is coming. So I want to go through those a little bit. First of all, I want to take a side note and kind of mention a couple of things as far as economic data is concerned. So today, Friday, we had the PCE report come out, and I just want to show you some of the data on these charts. So the personal savings rate still on a year-over-year basis, well over the Fed funds rate, well above its pre-COVID average, and kind of hovering on a rate of change basis, a couple basis points above on a 3-month annualized above its pre-COVID trend. And then real personal income ex transfer payments is actually kicking up, so its rate of change is picking up. It has some work to do to get back up to pre-COVID levels, but obviously, we're dealing with inflation and things like that. That's kind of eating away at people's real income. What's really interesting is the real disposable personal income has really taken off. The last couple of months have been just these huge compounding annualized rates, and we even ticked up again. Year over year is more than double the pre-COVID average, and we're coming in at 3 times, four, was that four, almost 5 times the pre-COVID trend on real disposable personal income. And then our nominal employee compensation, and basically what this is just it's talking about employee compensation for not on a real basis, not adjusted, and this is just another metric. It's another lens to look at what employees are being paid. It's a little bit of a different lens from personal income or personal income ex transfer. It's a little bit of a different look from the average hourly earnings. And so it looks like it's stabilizing on a rate of change basis as far as it relates to it's not accelerating any further, nor is it decelerating, but it is still well above its pre-COVID average. And then the other thing that I wanted to point out from actually two other things from the PCE report. So just real PCE, real goods PCE, real services PCE. What I think is interesting is the last couple of months we've had this. And there's definitely a monthly reading in here that was exceptionally high. It was during that month where like egg prices were extremely high. Like I forget, they were up like 20-something% or 30-something%. So that still is factoring into this calculation. But the real goods PCE is coming up quite a bit. What's really interesting is to see real services PCE really at the right around the pre-COVID trend, both on a year-over-year basis and on the 3-month annualized basis, although it did accelerate about 30 basis points from the previous month's reading. And then PCE inflation, and I actually need to get rid of this because I have to update it. What can we say here? It's not great. It's better, but it's not great. On a year-over-year basis and on 3-month annualized basis, these numbers are way too close to the yellow line. And I want to specifically highlight core PCE because this is the one, 3-month annualized core PCE is the thing that Powell had been saying even going back to, April, May. I think not April. There's no FOMC in April. March, May, June of last year. You had this metric specifically mentioned. Right now it's compounding at 4.8% 3-month annualized, and its year-over-year is 4.6. So at best, you can say that core PCE suggests that as far as the Fed's goals are concerned, they are basically right about at restrictive. When we get this next 25 basis points, which is for sure, I'm just gonna, unless something happens on Monday and Tuesday, like this is happening. It's going to get another 25 basis points added to it, so this line will actually be up a little bit more. So at that point, we will finally be in restrictive territory. Now, I don't know if it's going to be sufficiently restrictive as far as the Fed is concerned, but I do think that, that will be finally the place where the Fed set its goal at in the March SEP at 5.125%. And so that's going to be, the Fed's going to meet its goal as far as that goes. And then the question will be, will they leave it open for future rate hikes, or are they just going to hold steady? Are they going to signal the pause? And I have some views about that pause that I'll share in just a minute. But then you see trimmed mean PCE and median PCE. All of these are well above their pre-COVID averages and trends, and well above the inflation target. And in the case of median PCE, pretty substantially above the current Fed funds rate, so not restrictive on that standpoint at all. PCE report is, again, it's showing that inflation is improving, but it's not improving enough at the rate required for the Fed to feel comfortable about not hiking on Wednesday next week. So you can expect the hike will happen for sure. And to show you, let me turn a couple things off really quick. To show you, the 3-month bond yield is between the 5% and the 5.25% range, and wherever the 3-month yield is, you can expect that the the brackets, I guess, if you want to say, are around that level are going to be the place where the Fed funds rate goes. And I talked about that last week in my video, so I would just encourage you to check out last week's video. You can find it on the channel. But because the rate is between this level, like you can expect the Fed funds rate to go to the 5 to 5.25% for the May meeting. And then the question will be to watch, will be to whether or not, this is going to go further. So once, let's see, so May 3rd. So once May 3rd happens, as long as we are in between basically here and here on the 3-month, then the yield will, the Fed funds rate will get hiked 25 basis points. And then the question will be, after May 3rd, is this going to move up? And if it does, that's going to open up the possibility of a June hike. But if we continue to see the yield sideways, then that's going to be the best indicator that there will not be any future hikes. Now, the question about the pause, I'm not sure what the Fed's going to say they're going to do. But I do want to address something that maybe a lot of people haven't really thought of when it comes to the extent to which a Fed pause will be bullish for markets. So I want to take us back to 2018 and into 2019. I don't have this pulled up. I'm going to use this for my newsletter on Sunday. So if you're not subscribed, make sure you subscribe. But basically, back when the Fed was hiking rates and when we got the Christmas massacre, the Q4 2018, bear market that got to about 20%, 21%. We had the bottom happen basically on Christmas Eve, and then early in June, it was Friday, June 4th. There was this word that came out where Powell essentially said, "Yeah, we're going to stop." And the reason why that was surprising was because back during the Fed meeting, the December 19th, 2018 Fed meeting, they had anticipated that they would hike, I believe it was another 2 rate hikes, and that had been down from their previous estimate, which was that they would hike 3 times in 2019. And so on the December Fed meeting in 2018, Powell said, okay, we're going to only do 2 hikes. That's what the SEP said. And then here on Friday the 4th, we got, this report that from these words straight from Powell that we were not going to get any further rate hikes, that they were actually going to pause. And we got on that news, the S&P went up over 3%. And that basically just kick-started, the V bottom out of that. And this time, I hate to use this phrase, this time is different. And the reason why this time is different is because, one, we're not on a V bottom, like we're not V bottoming out of here. So we didn't just go straight down. We also are at a different place in terms of rate hikes, where the Fed is going to hike this time, and then they've met their goal. This isn't a situation where it's going to be a dovish surprise. A lot of this, I think, my personal opinion is a lot of this hiking, pausing, I should say, at the 5.125. I think that's been baked in. Honestly, I really do think that has been baked in, because the March SEP, which should have been, in my opinion, I thought it was going to be kind of the dagger for markets. Kind of right after that, markets, appreciated back to the upside, and I think that that's because obviously in the FOMC statement they talked about some additional softening may be necessary. Then some people took that to mean that maybe March was the last hike. But at this point, we know from the March SEP that they didn't change their 2023 outlook. So that means that markets are going to, that means that, once they get here, they've met their goal. So this is a completely different scenario from 2018 and 2019, where basically the Fed, surprisingly, in early January, took 50 basis points of rate hikes off the table entirely in just one swoop. And that was the surprise. And so that's what gave markets the ability to just boom in 2019. And boom they did until, obviously, if we go back and we look, we had this boom until basically until the repo market started to crash. So they continued quantitative tightening, even though they paused rate hikes here. They continued quantitative tightening until July and into August when the repo market busted. And then they came in and started actually doing QE again. So they stopped QT, started doing QE, and that gave the market this last little push. And the circumstances are different here. So like I said, the first idea is that the Fed is not going to surprise anybody by pausing, because this was their goal. So, if they come out and say they're done hiking, that's not really, a surprise anymore. So there's nothing to jog. I'm not saying the markets won't continue to march to the upside, but we're not going to get a boom because it's not a surprise. It's not going to take the markets happily by surprise. The other thing that's not changing is that QT is not stopping. So the Fed is still removing assets from its balance sheet. And in general, global liquidity is drying up. And this is something I want to go to now. So why do I think that, even though I think that right now the 25 basis point hike next week is going to be the last one, I don't think that it's actually going to be bullish. And the reason why is because of what I just said about the Fed, the circumstances being different. And then also the chart that you're looking at here is the global net liquidity chart. If we just pull it back right here, you can see. So what you're seeing is you have SPX overlaid with SPX in white, overlaid with Bitcoin in orange, obviously. And then the blue line is global net liquidity. And I think this is probably the best version. I'm not the only one who uses it, and I didn't create it, but this is by far, from what I understand, from what I've seen, this is the best metric for global net liquidity out there. And so it's pretty substantial. It's pretty good. What you see here is obviously Bitcoin had a deviation with the FTX debacle that took place, but generally speaking, it and the S&P has been following net liquidity, not leading net liquidity. A lot of people will say things like, oh, the market sniffed it out, but that doesn't happen. The market is led by, at least since 2020, since March 2020, has been led by net liquidity. And so what I've done is I've got this chart up from October, starting in October, which is kind of when the global liquidity cycle kind of turned a little bit with China, and then with Japan as well, because you got the BOJ stepping in. You also got China like in late November and early December, or late November and into December. I would say, like, if you look here, the blue line, kind of when Japan came in October, as well as I think the Bank of England as well, but definitely the Bank of Japan. And then in late December, you get the China easing that took place, and that kind of brought liquidity up as well. And then liquidity came up and inflected at the beginning of February, and then it has been coming down. But then we got this bounce. We got that bounce in liquidity after the SVB collapse. And then basically since March 23rd, net liquidity has been on the way down. And today, the deviation is insane. And so I have the chart pulled up at this spot because I want you to see just how big the divergence is. I mean, the way that where this is right now, the S&P should be 200 points lower. Bitcoin, should be $5,000 lower. And I think what I'm concerned about is the magnitude of this move being, look at the white, where the last couple of days you had the S&P just shoot up, and then even Bitcoin rising the last couple of days. But you can see Bitcoin is actually curling down. I think what's surprising to me is that with the price action, especially here today at the end of the week, I'm surprised Bitcoin is not up above 30,000. I mean, it may end up there over this weekend, but I'm surprised that it's not already. To me, that's another warning sign, right? So even if we look at the chart of Bitcoin, it was kind of down a little bit today, but you can see it's coming back towards unchanged. You can see we've had these massive wicks. Big move up yesterday, but some massive wicks on Wednesday's price action. And so I think that this is, personally, I think that what's most likely going to happen, to go back to my liquidity chart, in every case when there's been a divergence, the market always came back to liquidity. The market always followed liquidity. And so, uh, like you can see that actually here in February, if you look at where my mouse is right here, you see that net liquidity was coming down. And so the S&P came down, and then Bitcoin, even though it had a little bit of a bounce, ended up coming down. And then the blue line starts moving up, right? And then the equity market and Bitcoin follows it up. So in this case, I think that we're going to get probably next week. I could be wrong. This may actually take a couple of weeks to happen, but I actually think that these lines, the orange and the white line, are going to come down closer to meet the blue line. And if the blue line continues to fall, then obviously that means that the correction is going to come down a little bit further. Now, this is not me calling for, like if I go back here, this is not me I'm not calling for the S&P to make a lower low than its March low, nor its December low. But I could see where right now where net liquidity is tracking puts the S&P right there, kind of in the mid 3950, between 3950 and 4000. So I'd be looking for that to take place, and from here, that's about 5%. And if it did get worse, then the next place to check to look for price to hold would be at just below 3900, which I believe then would be closer to a 10 actually it's not even 10, it's like almost 8% correction. But I think that it would probably be minor, and I think that would be enough to kind of reset the trend. And if you again look at the market tide indicator, normally when we get the best place to buy the dip is usually somewhere below. So it actually lines up really well if price were to come down and fall right here with the tide lines like that. That would be the ideal spot. So that's kind of the place that I'm targeting. I don't know if it's going to happen next week or the week after, or if it's going to take a month. Obviously, a lot can happen, not just in a month, but in a few days. So I do want to call that out as well. Like this net liquidity thing, that to me is the most telling. But you can also pull up, say if you look at the left panel on this chart, what's really interesting is the MACD histogram. Even though this candle had gone down really far and then has retraced up and made a higher high, the MACD histogram right down here is actually lower. It's coming in lower. And so the weekly trend is actually coming down. I think that's also a warning sign. And then what I would be watching on the right panel is if the MACD histogram comes up to the green, and price has already made a higher high. So if price comes up to the green, but then doesn't make a higher high on the histogram, then that's going to be basically the third time in a row that we got a bearish divergence. And that is a warning sign, because usually the more you compound those types of divergences, the more ferocious the downside move will be. So definitely want to watch out for that. So the FOMC is the big hot ticket next week, as well as non-farm payrolls on Friday. We also have Apple earnings on Thursday next week. So there's a lot of potential macro moving events. I'm sure 0DTE will be all over it. And then the other thing I wanted to point out really quick is I want to go to my my signals here, my scatter plots. So what you don't like to see on these scatter plots is the majority of assets on, and I track like 73 assets on this. You don't want to see, 75% or more of them in this bottom right quadrant, and that's where more than 75% of them are. And that's usually an indicator that, or an indication that there's complacency in the markets. And then I also want to call out on the tax signal plot that there is a bearish signal in XLP, that's consumer staples. That is very overbought, and it has outperformed much of the market and is a little overextended. So you want to watch for that too, to pull back over the next few weeks. So with that, I think I'm going to cut it off right there. Just be careful. Now is not the time to get super excited. Remember how far equity markets have come up. Equity markets are up over 16% off the lows, but now is not the time to FOMO into the markets, which is unfortunately what I'm afraid is happening. A lot of excitement out there, and this is not the time. Like the VIX, look at the VIX. VIX is at 15. It's under 16. This is not. This is complacency. And usually, like all throughout, like, I mean, people want to talk about like the despair that people were feeling back here in October. I mean, when crypto is looking to pump the next coin, and when you've got, unprofitable tech that is squeezing, and you have people asking if it's time to buy the dip, and and then when you have the euphoria, what seems to me to be euphoria that has existed over the last little bit, this is not the time to jump in. To me, the risks are too high, and if there's anything that you take from this, understand the liquidity picture here is not favorable to the markets continuing to the upside. Now, there is that saying that the markets can stay irrational longer than you can stay solvent, but I would just call out that even if the markets do continue up, like at 4,200, you should be selling the heck out of this thing. I mean, not financial advice, but that's what I would be doing, because unless we get a major inflection in liquidity to the upside, like there's no way that can continue. I mean, unless you think that that everything has changed now and that liquidity is no longer a driver of the markets. But right now, it looks like that's what it has been. The other thing I want to say is I do want to acknowledge that this kind of downtick might have something to do with drain on the reverse repo. I haven't been able to refresh my models to look at it. So that's entirely possible. So we might, in all likelihood on Monday, we might see a little bit of a bounce up, but it's not really about whether it bounces up. It's whether, it can break kind of this downward trend to the upside. And, if you think that that these moves in the S&P and in Bitcoin are justified, then basically what you're saying is that liquidity is going to go up. What is this? That liquidity is going to go up like $700 billion in the next week. And that's just not likely. The Fed's not going to, basically the Fed's not going to print like that unless something has broken. And the only way that it'll be evident that something actually broke is not for the S&P to be just below 4,200 and not for Bitcoin to be just below 30,000. So fair warning, just be careful out there. But with that, I hope you guys have a fantastic weekend, and I'll see you guys next time.